All eyes are on the US this week with all important economic data, Federal Reserve Ben Bernanke's testimony and Friday's sequester deadline looming. Should Congress fail to act, it could result in half a percentage point cut in GDP. But would this be a short-term pain for a longer-term economic gain? With all this in mind, I'm joined down the line by Alexandra Estiot for her outlook on the US economy. Alexandra, consumer confidence came out at 69, which was much higher than expected. But according to some analysts, it's political standoff over the US budget which is slowing down the US economy, more so than any hesitance by Americans to spend freely. So what can we take from these figures?
Well, to sum it up, if the U.S. economy was just about the private sector, I would be indeed very confident that we are about to see it strengthening, as several headwinds have abated. And but the thing is that the government does exist, and politicians are fighting hard about how to fix deficits. And this is why we're going to have the sequester, automatic spending cuts that will occur at the end of the week. And actually, for some Republicans, it's the only way to be sure that federal spending is going to be cut. But all this is definitely a cause for concern for households, since the standoff is going to have at one point to be resolved, but we don't know anything about the ways and means. So it means that it's difficult to have a clear view about the future path for jobs and income and so consumption.
In his testimony, Bernanke said, "We do not see the potential cost of increased risk taking in some financial markets as outweighing the benefits of promoting a stronger economic recovery." Therefore, what is your assessment of this statement so far?
Well, it makes sense for Bernanke to stress that monetary policy has to remain a commodity for a long time. A few months ago, the Vice Chair, Janet Yellen, made a very interesting presentation, and what she showed is that the longest you have a monetary accommodation, the bigger the chance that the economy is strengthening. And this is the case when you exiting from a financial crisis as terrible as it was in 2008 and 2009. And the thing is, the Fed members have been telling us this several times, is that the very accommodative stance of monetary policy is just starting to be effective in the housing market, because for a long time households were just trying and cut their indebtedness, and whatever the level of interest rates, they are not ready to come back on the housing market. And but for sure, there are possible costs linked with QE, but the thing is that it's not good reason not to act now to fight a difficulty, a very effective problem, having in mind that at one point it will be another problem. Better start now and deal with it later. Plus the big thing is always about the risk of seeing inflation accelerating, and this is really something we don't see into data. All price indices, consumer, producer, import prices, every piece of data show that there are no inflationary pressure in the US.
You mentioned households earlier. Home prices in 20 US cities rose in the 12 months to December by the most in more than 6 years. A recovering housing market would go a long way to instill confidence, but do you think this current progress is sustainable?
Well, for sure it won't keep growing that fast. But the thing is that with the economic and financial crisis of 2008-09, the overall construction sector just collapsed. And it went from a big thing in the economy to something which is hardly noticeable. So the thing is that you have a very fast rate of growth in housing starts and home sales and so on. But this is because the levels are really, really small. And the thing is that if you compare not the growth rates, but the level of sales and starts, you see that we are not just very far from the previous peaks, but also very, very far from the long-term averages. So what we expect is the recovery in the housing sector to keep going. So for now, we're going to still have strong rates of growth, and this will slow down, but it won't be a bad thing.
Now, obviously, we can't forget the tailwinds which will be emanating from Europe. The S&P 500 fell the most since November yesterday, as Italy's inconclusive election results raised concern that the euro area's debt crisis will worsen. But some encouraging signs have emerged. Germany reported a larger than expected budget surplus month, and Germany's business confidence rose in February for a fourth straight quarter. What impact, if any, do you think this will have on US exports?
The direct impact from a German recovery is to be minor for the US, but it's actually just another sign that the manufacturing sector is strengthening globally, and this had evidence to the expected strengthening of the US. So this is just another piece of good news showing that the global environment is getting better, even though Germany is not to import more from Europe, from the US. But as long as the German economy is getting better and helps the other Eurozone countries, it will have benefit for the US, even if it's going to be minor.
Going back to Bernanke's testimony, it had potential to dampen US gains temporarily. Do you think market confidence will, however, remain due to the knowledge that other Fed members are already favouring an earlier exit from QE3? And what is your outlook for the dollar moving forward?
Outlook for the dollar is really focused not on economic data, but much more on developments in politics. Right now, we have the Italian situation, which is putting some stress on the euro, and but when it's going to be resolved, the focus is very likely to turn once more on what's happening in Washington, because we have the sequester starting on Friday, but at the end of the month we also going to have the end of the continuing resolution, which is what allows the federal departments and agencies to spend. And this is a very big risk, because if the Congress doesn't manage to find another piece of law, the risk is to see the government shut down. So progressively, I'm sure that the focus is going to be back on the dollar, and very likely pressure on the dollar.
Alexandra, thank you very much for your time and perspectives today. Now, the TV team will bring you a market reaction of Bernanke's subsequent Q&A tomorrow, so please do click back for that. But for now, goodbye.